Canadians are losing up to $47,000 from their RRSPs without even knowing it. Today, I'll show you how to stop that. At 2 o'clock, we'll expose the $47,000 blunder. Then, at 4 o'clock, discover the hidden RRIF tax trap. And by 6:30, you'll have a strategy to keep thousands more of your money. Here's mistake number 1. Most Canadians think a withdrawal is just a simple transfer, but it's not. You've poured years into your RRSP, dreaming of a secure retirement. But what if a sudden need, like a home repair or medical expense, forces an early withdrawal? Many are blindsided by the tax man. Imagine Michael needing $40,000 for a new roof. He pulled it from his RRSP, expecting a small withholding tax. But come tax season, he discovered over $15,000 of that was gone in unexpected income tax, turning his urgent repair into a major financial shock. In this video, we'll unmask these hidden tax traps, clarify the critical difference between RRIFs and lump sums, and arm you with strategies to safeguard your retirement. We'll demystify Canadian tax rules, show you how to stay in lower tax brackets, and give you an actionable plan to avoid this $47,000 mistake today. This information isn't theory, it's about keeping your hard-earned money. If this already makes you think differently about your RRSP, hit that like button now. Step 1. Unmasking the $47,000 RRSP withdrawal blunder. Many Canadians only consider the initial withholding tax when withdrawing from their RRSP. They think that 10%, 20%, or 30% deduction is the end of it. But this is where the $47,000 mistake begins. That withholding tax is just a down payment. The real tax hit comes when your withdrawal is added to all your other income for the year, potentially bumping you into a much higher tax bracket. For instance, you might withdraw $47,000. Your bank withholds, say, 30%, so you receive $32,900. But if your annual income pushes you into a 40% combined federal and provincial tax bracket, you're looking at an additional $4,000 to $10,000 or more in taxes come April. This isn't just for early withdrawals. It applies to any withdrawal if not managed correctly. This is the real-life impact of that $47,000 mistake, reducing your net gain significantly. Before any RRSP withdrawal, calculate its potential impact on your annual taxable income. Don't rely solely on the withholding tax. Understanding this immediately saves you from unexpected tax bills and avoids the shock of seeing your savings shrink dramatically. This next error affects 73% of Canadians who are nearing retirement. Step 2. Decoding the hidden tax traps and RRIF decisions. Canadian tax rules around RRSPs and RRIFs are notoriously complex. Every dollar you pull from an RRSP is taxable income, no exceptions. The critical decision point arrives at age 71, when your RRSP must convert to a RRIF, or Registered Retirement Income Fund. This isn't a mere formality. It fundamentally alters your withdrawal options and introduces minimum withdrawal requirements. This conversion is a hidden tax trap if you're not prepared. Consider the RRIF versus lump sum dilemma. If you have, say, a $200,000 RRSP and decide to cash it all out as a lump sum at age 71, you could face massive tax implications. That $200,000 added to any other income could easily push you into the highest marginal tax bracket for that year, where you might pay upwards of 45% to 50% in taxes. That's $90,000 to $100,000 gone in a single year. A RRIF, however, mandates minimum withdrawals, which, while still taxable, can be strategically spread over many years. This allows you to plan your income to keep you in lower tax brackets, saving you potentially tens of thousands of dollars. Actionable step. If you're nearing retirement or considering a large withdrawal, meticulously research the specific tax implications for your province and income level. Better yet, consult a tax professional before converting to a RRIF and fully grasp the minimum withdrawal rules. By understanding these rules and making informed decisions, you can avoid a single year of punitive taxes and ensure a steady, tax-efficient income throughout retirement. But wait, there's something even better that 95% of people don't know. Step 3. Optimizing your withdrawals for maximum income. The objective isn't merely to avoid mistakes, it's about optimizing your withdrawals to maximize your retirement income. This involves a deep understanding of tax brackets and strategically timing your income to minimize your overall tax burden. This is the pro secret that 99% of Canadians miss when they seek smart RRSP withdrawal strategies. Instead of one massive withdrawal, think strategically. Consider smaller, periodic withdrawals spread across multiple tax years, especially during periods when your other income is naturally lower.
For example, if you're planning to retire and anticipate a year with no other major employment income, that's your golden opportunity for a larger planned RRSP withdrawal. This allows you to utilize your lower tax brackets effectively before your pension or other retirement income streams fully kick in. This proactive approach is the core of tax-efficient planning. Immediate action plan. Develop a multi-year withdrawal strategy that anticipates your future income needs and aligns perfectly with Canada's progressive tax brackets. And here's another pro tip. Consider depleting your tax-free savings accounts, TFSAs, as your primary withdrawal source first before you touch your RRSP or RRIF. TFSA withdrawals are, as the name suggests, completely tax-free. This strategy can save you tens of thousands of dollars over your retirement, effectively boosting your retirement income and extending the life of your savings. This is your action plan to avoid the $47,000 RRSP withdrawal error today. If you found these strategies helpful so far, tell me in the comments, what's your biggest takeaway from this video? The information shared today isn't just theory, it's about actively protecting the financial future you've worked so hard for. Every dollar you save from unnecessary taxes is a dollar that contributes directly to your financial peace of mind and security. Remember, the biggest mistake you can make with your money is not understanding how it truly works and the rules that govern it. Take control of your RRSP and you take control of your retirement. This is your final warning. The most important rule before touching your RRSP is profound knowledge and a solid plan. Results vary depending on individual financial situations, but the principles remain the same. If this video opened your eyes to the hidden costs of RRSP withdrawals and empowered you to make smarter choices, please hit that like button, subscribe for more essential Canadian financial insights, and comment below. What's your biggest takeaway, or what other RRSP questions do you have? Your engagement helps us bring more valuable content to Canadians. Don't let the $47,000 RRSP withdrawal mistake be your mistake. Empower yourself with knowledge, plan wisely, and ensure your retirement years are as financially secure and comfortable as you've always dreamed. Your future self will profoundly thank you for taking action and gaining this crucial understanding today. Next time, we'll dive into how to choose between an RRSP and a TFSA to maximize your long-term savings, potentially adding another $10,000 to your net worth.